Hey traders, Gavin McMaster here from Options Trading IQ, and today we're going to be looking at whether you should sell covered calls or cash secured puts and some of the main differences. Before we start, just a quick reminder, everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So, should you sell covered calls or cash secured puts? They're both great strategies for beginners, but why would you choose one over the other? And are there any benefits to covered calls over cash secured puts and vice versa? Let's break it down in this video. So cash secured puts are great if you want to wait and potentially purchase the stock at a lower price. So basically, if you want to take ownership of a particular stock, say it's Apple, trading at say 220, you might sell a put at 210. And if Apple comes down below 210, you'll be assigned and you'll take ownership at 210. If it doesn't come down below 210, the put will expire worthless. You keep the premium and you can start the process again. Some people prefer to hold large cash balances, which can then be used to generate interest by putting that into high interest savings accounts or T-bills. So that's basically what I'll do if I want to sell some puts on a particular stock, potentially take ownership of that stock. I'll leave the cash sitting in my mortgage offset account, or I'll purchase T-bills and be earning sort of 5% on that idle cash while I'm waiting for those puts to get assigned. So you can actually generate quite a high interest piece on that cash that's just sitting there waiting, provided that you do have the cash to take ownership if you need to. One thing to be careful of is to not sell too many cash secured puts and overexpose your account. Now, this is a mistake I made many years ago. Got too aggressive and ended up taking on more exposure than I could actually handle. And then when the market corrected, came under pressure with those positions showing losses and being assigned on more positions than I really wanted to be assigned on. So number one is make sure you have enough cash to cover assignment on all your cash secured puts if called upon to do so. Very important point there. Let's take a look at covered calls. So covered calls are better in a bull market, and we're going to see why in a minute, because they have higher upside appreciation, assuming the call is sold out of the money, of course. So covered calls can profit from the option premium and an increase in the stock price, whereas cash secured puts only profit from the option premium. As a stockholder, you also get to receive any dividends during the life of the trade. So let's compare a 15 delta cash secured put and a 15 delta covered call. Both have a roughly 85% chance of the option expiring worthless, but the covered call has a much higher profit potential, as we're going to see in a minute. So we're going to use Apple as our example. We're going to go in here to Risk Navigator, and I'm going to set up a 15 delta covered call. And then we'll set up a 15 delta cash secured put, and we will compare the two. Now, unfortunately, we haven't got perfectly 15 delta here, so I might go out to the March expiration, see if we can find something. Got an 18 delta and a 13 delta. I might use the 18 delta, and then I'll use the 19 delta put because they're quite similar. Ideally, I was hoping to get a 15 delta put and a 15 delta call, but work with this. This is fine. So firstly, the covered call, we buy 100 shares of Apple and we sell that 18 delta call against the stock position. Now, don't worry too much about any of the Greeks or anything like that. I've got other videos if you want to learn about the Greeks, but let's just look at the profit and loss graph. And I'll just set this up here. All right, so here we can see we've got a total profit potential. The blue line is our profit and loss at expiration. The purple line is our profit and loss as of today. Profit potential of just under $2,500, maybe about $2,400. So very, very nice profit potential because we've got the potential to make the income from the option of $210, but we've also given ourselves some upside on the stock between $238.20 and $260. So we've got some capital gain potential built into the trade here on the stock position. This has a roughly 18% chance of expiring worthless. Now, we could do a 19 delta put instead. And you'll see here, very different looking profit graph. Our capital is actually kind of the same shape, but it's a lot lower. And our profit potential is limited to that $276 in option premium. There's no capital gain potential because we don't own the stock. We've got no upside potential. So even though both options have a roughly 82% chance of expiring worthless, So both these options have an 81, 82% of expiring worthless. We've got similar income potential on the option, slightly higher income potential with the put than the call. But the big difference is the capital gain potential on the covered call, because we have that gain potential on the stock. Now, one interesting thing with options, you can create the exact same trade with puts or calls. There's a sort of saying in the market, a put is a call and a call is a put. Now, I'll show you something a little bit interesting here that you may not know. Instead of doing this covered call, we could basically create the exact same strategy with a cash secured put if we wanted to, by actually selling an in the money put. So we use the same strike as our covered call, and let's take a look. So here's our covered call trade. Zoom in a bit here. That was our roughly 2,300, 2,400 profit, or 2,200 probably. So let's take a screenshot of that. And let's compare if we're to sell an in the money put. Very, very similar profit potential. Now, the main difference being this put is in the money and it's likely to get assigned. But basically, with any option strategy, you can create the same payoff graph with puts or calls. Anyway, a little bit of an interesting aside for you there, but not many people are going to sell in the money puts. Most people are going to sell this one, or they're going to do the covered call. But we can really see a difference between the 15 delta cash secured put and the 15 delta covered call. So thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share your thoughts in the comments below. Reach out anytime with questions, and have a great day.